Now let us start discussing income from other sources. Last head of income. We finished our discussion with regard to house property, salaries, PGBP, capital gains. Now let us start discussion with regard to income from other sources. Section 56 to 59. These are the sections covered under the head income from other sources. What are the sections? 56 to 59. Charging section is section 56. So charging section in any head of income, charging section will specify certain conditions. If those conditions are satisfied, income is taxable under that particular head. Even under other sources also, section 56, charging section has specified some conditions. Only if those conditions are satisfied, income is taxable under the head other sources. Shall we see those conditions? There must be an income. Such income is not exempt, because if income is exempt, will it be taxable? It is not taxable. So there should be an income. Such income should not be exempt. Such income should not be chargeable under other heads of income. That means we call income from other sources as residuary head. Those incomes which are not taxable under earlier four heads of income will be taxable under the head income from other sources. Are you able to understand? So for an income to get taxed under other sources, three conditions are required to be satisfied. There should be an income, such income should not be exempt, and such income should not be taxable under other heads. If these three conditions are satisfied, income is taxable under the head other sources. Hello, Mr. Krishna. What is the method of accounting followed? Under the head PGBP as well as under the head other sources, method of accounting followed is same. Accrual or cash basis, whichever is beneficial to the SSE. That means whatever the method of accounting followed by the SSE is there, whether it is accrual basis or cash basis, that method of accounting is applicable for calculation of income under the head other sources. Is it clear? Except interest on compensations and dividends, because interest on compensation is always taxable under other sources. First important concept under other sources is gift concept. Okay, lot of weightage is there. Question can be asked in any way. The concept is a little bit complex. Many conditions are there. So listen very carefully. It will be very easy only. First of all, gifts are taxable in the hands of all SSEs. That means what? Once upon a time, when I used to study CA IPCC, at that time gift is taxable only in the hands of individual or HUF. But nowadays gift is taxable in the hands of all SSEs. Are you able to understand? Next, gifts are taxable only if the value of benefit is exceeding 50,000 rupees. Let's say I received a gift. I received small gold coin. Value of gold coin is 11,000 rupees. That gift is not taxable because value of gift is less than 50,000. So gift is taxable for all SSEs, and gift is taxable only if value of gift is more than 50,000. Value of benefit received is more than 50,000. Next, gift are taxable whether recipient is resident or non-resident. Gift are taxable whether donor is resident or non-resident. What do you mean by this? Let's say there is donor, there is recipient. Okay. The person who gave gift is resident. The person who received gift is resident. Whether that gift is taxable? Yes, it is taxable. The person who gave gift is resident. Recipient is non-resident. Whether that gift is taxable? Yes. The person who gave gift is non-resident, recipient is resident. Whether it is taxable? Yes, it is taxable. The person who gave gift is non-resident, the person who received gift is non-resident. That gift is not taxable. Are you able to understand? Now did you understand the point? Though donor can be either resident or non-resident, recipient can be either resident or non-resident. But if donor and recipient both are non-residents, means that gift is not taxable. Think logically. Okay, person who is there in Australia gifted a gift to another person who is located in USA. That means one non-resident in one country is giving gift to another non-resident in another country. Why the hell will it get taxed in India? It will not be taxed in India. Are you able to understand? There is no nexus. Next, gift in kind are taxable only if such asset is covered under the definition of property. That if you have received gift in cash, if value of gift is more than 50,000, it is fully taxable. But you have received gift in the form of kind, then you have to check whether the gift that is received in the form of kind, is it falling under the definition of movable asset or not. Okay, only if it is considered as movable asset or only if it is covered under the definition of property, then only gift is taxable. Here property definition was given, you can see. Property means, in case of immovable property, property means land or building or both. In case of movable property, property means jewelry, drawing, painting, sculpture, archaeological collection, work of art, shares, securities, virtual digital assets. So whatever exceptions to definition of personal effect are there, all are given here. That means what? I received watch as a gift. Now, in that watch, no jewelry is there. It's a plain watch. Even the watch value, I received a Tissot watch worth 78,000 rupees. Even the value of watch is more than 50,000, still that gift is not taxable because watch is not covered under the definition of property. Is it clear? So whenever you are receiving gift in the form of kind, whenever you are receiving gift in the form of kind, that is taxable only if it is covered under the definition of property. You received iPhone as a gift, whether iPhone is jewelry, whether iPhone is drawing, whether iPhone is painting, sculpture, whether iPhone is shares and securities, whether iPhone is virtual digital asset. No, even if you receive iPhone, even iPhone value is more than 50,000, still it is not taxable. I will tell another example also. Your friend gifted Audi Q7 worth 70 lakh rupees. Even though Audi Q7 is gifted to you, even though its worth is more than 50,000 rupees, still it is not taxable because car is not covered under the definition of property. It's a loop. Okay. So, gift in kind is taxable only if it is covered under the definition of property. What is the definition of property? In case of immovable property, land, building or both are considered as property. In case of movable property, jewelry, drawing, painting, sculpture, archaeological collection, work of art, shares, securities, virtual digital assets, only these are covered under definition of property. That means only if these assets are received as gift, then only gift taxation is applicable. Other than the assets covered under the definition of property, if any other asset is received as a gift, gift taxation is not applicable. Best example, watch, mobile, car, okay, refrigerator, someone gifted you air conditioner, someone gifted you washing machine, okay, those are not covered under the definition of property. Even though their value is more than 50,000, such benefit is not taxable. Let's say my friend recently went to Singapore. He told me he will bring me one camera. This camera does not belong to me. This camera belongs to KS Academy. Let's say worth of this camera is 90,000 rupees. Let's say, for example, of course I will pay him money. For example, I did not pay him any money. He gifted that camera to me. Now that camera is not taxable to me because camera is not covered under the definition of property. Is it clear? Are you able to understand? But if I use it in my profession, okay, I can claim depreciation. At that time, if it is first hand asset, actual cost I will take. If it is second hand asset, original cost minus notional depreciation. Do you remember? Bhul gaya? We have discussed very clearly depreciation. Next, gift in kind are taxable only if such asset is treated as capital asset in the hands of recipient. What do you mean by this? Let's say there is me, there is my friend. I gifted a building to my friend. In hands of my friend, building is capital asset, right? So this gift is taxable. That gift is taxable. This is case 1. Case 2. I gifted a building to my friend whose name is Satish. Satish's main business is real estate business. His main business is real estate business. As I wanted to encourage my friend, whatever the land that I am having, for example, I gifted that land to my friend Satish. On that land, he constructed flats and he sold all those flats. That means whatever the land that I gifted to my friend, he is not using as a capital asset, he is using it as a stock in trade. Okay, what I gifted building. What is the nature of building in the hands of Satish? Nature of building is stock in trade. Now whatever the gift that I have given, that gift is not taxable in the hands of Satish. Are you able to understand? That means in the hands of recipient, whatever the gift that is received, if such gift is stock in trade in the hands of recipient, such gift is not taxable in the hands of recipient. Are you able to understand? First, gift concept is applicable for all SSCs. Gift is taxable only if value of benefit is more than 50,000. Gift is taxable irrespective of whether donor is recipient or non-resident, irrespective of whether recipient is resident or non-resident. Gift is taxable only if such gift is covered under the definition of property. Next, gift is taxable only if such gift is treated as capital asset in the hands of recipient. Are you able to clear cut, like crystal clear with the concept? Next, gift is exempt in following cases. In certain cases, gift is not taxable, gift is exempt. When if gift is received from relative. Very important. In your families also, the moment your relatives come to know that you are studying chartered accountancy, they will immediately call you and ask, "Are I am gifting gift, I'm giving gift to so and so person who is my relative. Will it be taxed under income tax or will it be exempt?" So, in order to answer that question, you should be very clear with regard to definition of relative. Only if recipient is covered under the definition of relative, then only gift is exempt, otherwise gift is taxable. Is it clear? Sumit, in the first hour you are sleeping. Are you into dreams and listening income from other sources? Now, shall I explain who is considered as relative? In case of individual, always who is considered as relative first? Spouse. Else war will happen. So, in case of individual, first relative is spouse. Next, second relative is brother and sister of the individual. Okay, sisters, individual's brother, individual's sister. Next, third relative is brother and sister of spouse of the individual. That means spouse's brother, spouse's sister is also considered as relative. Next, fourth, brother and sister of parents of the individual. Individual will have mother or father, right? So mother's brother, mother's sister, father's brother, father's sister. They are also considered as relative. Under fourth point. Under fifth point, lineal ascendant. Lineal ascendant means what? 3 generations upwards. Mother, father, grandmother, grandfather, great grandmother, great grandfather. What you call Jejamma, Mayamma. Oh. Next, under fifth point only, lineal descendant is also covered under definition of relative. Lineal descendant means son or daughter, grandson or granddaughter, great grandson or great granddaughter. Under sixth point, spouse's lineal ascendant and spouse's lineal descendant are covered under the definition of relative. That means spouse mother father, spouse grandmother grandfather, spouse great grandmother great grandfather. And spouse lineal descendant means this only, right? Next, under seventh point. Before I explain seventh point, let us revise 6 points. First, who is considered as a relative? Spouse is considered as relative. Second, not only spouse, brother and sister of the individual are considered as relative. Third, brother and sister of spouse of the individual are considered as relative. Next, brother and sister of parents of the individual are considered as relative. That means like maternal uncle, maternal aunt. Okay. Now, fifth point, lineal ascendant and lineal descendant of the individual. Individual's mother, father, individual's grandmother, grandfather, individual's great grandmother, great grandfather. Lineal descendant, individuals son or daughter, individuals grandson or granddaughter, individuals great grandson or great granddaughter. Okay. Under sixth point, spouse's mother or father, spouse's grandmother or grandfather, spouse's great grandmother or great grandfather. Lineal descendant is same. Under seventh point, those who are covered under second point to sixth point are there. Even their spouses are also considered as relative. So under second point, brother's spouse, sister's spouse is relative. Spouse, brother's spouse, spouse, sister's spouse is also considered as relative. Mother's brother's spouse, mother's sister's spouse, father's brother's spouse, father's sister's spouse. They are also considered as relative. Next. Son or daughter and their spouse, grandson or granddaughter and their spouse, great grandson or great granddaughter and their spouse are also considered as relatives. You always have to check from receiver point of view. From receiver point of view, if donor is relative, then such gift is fully exempt. So first, from whose, whenever you see SSC in the question, assume yourself as the SSC. So if the donor is relative to you, then that gift is fully exempt. Are you able to understand? You have to check from recipient point of view. If the donor is relative, such gift is fully exempt. Now I will ask you one question. uh, my sister's daughter, she is very cute, she gifted me one gold chain. Now whether that gift is exempt to me or taxable to me? Here who is receiver? I am the receiver. You should check from my point of view. Who is the donor? Sister's daughter. Sister is covered under the definition of relative, but sister's daughter is not covered under the definition of relative. Now reverse. As my sister's daughter is very cute, I gifted her gold chain. Whether that gold chain is taxable to her or not? Who is receiver? My sister's daughter. My niece is recipient. Who is donor? I am the donor. From whose point of view you should check? From donor point of view will you check? No. From this. So my niece point of view, mother's brother gifted to my niece. So mother's brother means obviously relative, right? So such gift is fully exempt. Are you able to understand? So, relative definition very crucial. I will once again summarize it. In case of individual, spouse is relative. Not only spouse, brother and sister of the spouse are relative. Brother and sister of spouse of the SSC is relative. Next, brother and sister of parents of the individual are relative. Lineal ascendant and lineal descendant of the individual. Lineal ascendant and lineal descendant of spouse of the individual. From second point to sixth point, whoever got covered, even their spouses are also considered as relative. Okay. So did you understand relative tree? Mind tree laga relative tree. Next. At the time of marriage of the individual, if any gift is received, means at the time of marriage of individual, if any gift is received, such gift is fully exempt, irrespective of count of marriages. Even if he gets married for 10th time or 15th time, still whatever the gift that is received, it is fully exempt, full happy. So you can do tax planning. Whenever any person wants to gift you, you can hold on them. Sir, next month I'm going to get married, don't give now, give it on the date of my marriage. Next, under a will or by way of inheritance. So let's say father died, all properties of father got inherited by son. So by way of inheritance, if any capital asset is received, if any assets are received, it is not taxable. In contemplation of death of the payer or donor, applicable only for movable properties. Let's say there are old people old grandmother and grandfather are there. They do not have any children. However, Mr. A and Mrs. A have done service to old grandmother and old grandfather during their last days. As a token of gratitude, that old grandmother and grandfather transferred all properties to Mr. A and Mrs. A. Whatever the movable property that is received by way of contemplation of death of the donor. Okay, movable properties received are exempt. However, immovable properties received will be taxable. From any local authority, if any gift is received, such gift is fully exempt. So you performed in one concept, conducted by GHMC, Greater Hyderabad Municipal Corporation. So GHMC paid you some 2000 rupees or 3000 rupees, whatever the amount that you have received. Of course it is less than 50,000, but whatever the gift that is received from local authority is there, such gift is fully exempt. Next, trust registered under section 12AA, university or education institution registered under section 1023C. Listen carefully. Listen. Trust registered under section 12AA, hospital registered under section 1023C, education institution registered under section 1023C. 12AA, 1023C, you are going to study in your final. Okay, don't think much, but please remember, any trust that is registered under section 12AA, any education institution or university or hospital registered under section 1023C. For these institutions, even if you give any gift, that is fully exempt to them. From them, even if you receive any gift, such gift is fully exempt. Is it clear? That means gift given to them, gift received from them, such gift is fully exempt. Okay, trust registered under section 12AA and education institution, university, hospital registered under section 1023C. So even if you give any gift or if you receive any gift from them, such gift is fully exempt. Next, there are exceptions to definition of transfer, right? Transfer of capital assets at the time of partition of HUF from Indo-divided family to small family. Transfer of capital assets from amalgamating company to amalgamated company. Transfer of capital assets from demerged company to resulting company. Do you remember all those? So in all those cases, in the hands of transferor, capital gains are not required to be calculated because the transaction is excluded from definition of transfer. Even in the hands of recipient also, that is not taxable because that is excluded, like that is covered under exempted cases of gift. Is it clear? మనకి నిద్ర వస్తుందా? హాయిగా క్లాస్ చెప్తుంటే జోల పడుతున్నట్లు ఉంది వాడికి. అర్థమైందా? If gift is received from an individual by a trust created or established solely for the benefit of relative of the individual. So let's say an individual loves his mother so much. Okay, in the name of his mother he started the trust. Whatever the properties that he is having, land and building, he transferred those buildings, land and building in the name of the trust. And the trust was created solely for the benefit of the mother, solely for the benefit of the relative of the individual. So to that trust, even if any property is transferred in the hands of trust, such gift is not taxable, it is fully exempt. Next, any gift received by an individual from any person in respect of any expenditure actually incurred by him on his medical treatment or treatment of any member of his family. What do you mean by this? Let's say SSC or family members, SSC or family members, they are suffering with COVID-19. They are suffering with COVID-19. Treatment of COVID-19. For treatment of COVID-19, medical bills are paid. Medical bills are paid by another person. Whatever the medical bills paid by another person, it is gift, right? For example, hospital bill is 4 lakh rupees. 4 lakh rupees is paid by friend. That 4 lakh rupees is also in the nature of gift, which is greater than 50,000 rupees. But that benefit is not taxable. That benefit which is in the nature of gift, it is fully exempt. Are you able to understand? So by way of reimbursement of COVID-19 medical bills, if any amount is received in the form of gift, even though such amount is more than 50,000, such benefit is not taxable, such benefit is fully exempt. Are you able to understand? Now read that point, you will get clarity. Gift received by an individual from any person, that means from any third party, in respect of any expenditure actually incurred by him on his medical treatment or treatment of any member of his family for any illness relating to COVID-19, subject to satisfaction of these conditions. Shall I explain the next point? Everyone, see the last point. If any gift is received by any member of the family of a deceased person from his employer or from any other person subject to some conditions, you can see from employer of the deceased person without any limit, or from other person or the persons to the extent that such sum or aggregate of sums should be less than or equal to 10 lakhs subject to following conditions. What do you mean by this? SSC hit the bucket, individual hit the bucket. Okay. After death of individual, family persons received compensation. Family persons received compensation. That means what? Let's say individual is there. He got COVID-19 and he died. His family has nothing. No one is there to take care of the family. In this situation, someone came forwarded to help such family. Compensation was given. If compensation is received from employee, if compensation is received from employer of deceased individual means those who died. If compensation is received from deceased if compensation is received from employer of the deceased individual, okay, total compensation is fully exempt. Total compensation is fully exempt. If compensation is received from any other person, if compensation is received from any other person, if compensation is received from any other person, in that case, such compensation, all compensations together, if it is less than or equal to 10 lakhs, then it is exempt. If all compensations together, if it is greater than 10 lakhs, then excess is taxable. Is it clear? So upon death of an individual, if any compensation is received, if such compensation is received by family members from the employer of the deceased person, then total compensation received is fully exempt. If compensation is received from any other persons, all compensations received together, aggregate compensations received, if it is less than or equal to 10 lakhs, fully exempt. If it is greater than 10 lakhs, then excess is taxable. Okay. But two conditions are required to be satisfied. The cause of death of such person should be because of COVID-19. Payment is received within 12 months from date of death of such person. What do you mean by this? The date on which individual died because of COVID-19. From that date onwards, within 1 year, compensation should be received. Then only exemption is available. Otherwise, exemption is not available. Okay. And in case of individual, family means who? Spouse and children of the individual, parents, brothers and sisters of the individual, wholly or mainly dependent on such individual. Okay, they are considered as family members. Now, shall we see valuation of gifts? Everybody? Listen very, very carefully. Okay. Don't look at the material, just look at the screen. You will get complete clarity. Gift can be received either in the form of cash or in the form of kind. Correct? Do you agree with me? Gift in kind can be received either in the form of, please tell they are talking, ask them not to talk. Movable property. Gift in the kind can be either in the form of movable property or in the form of immovable property. Do you agree with me? Gift received in the form of movable property can be received either for without consideration or for inadequate consideration. What do you mean by this? For example, tomorrow Kaushik became so rich, I already told you, he became gold businessman. One fine day I went to his gold shop. He said, "Sir," I said, like I wanted to purchase one small bracelet for me. I said, "Sir, you already have me, sir. But I have, I have interest for bracelets." I said, "I wanted to purchase another one." So he personally took me to that bracelet section. He showed me all the bracelets. He showed me the latest one. He showed me the one with utmost purity and all. I said, I selected one bracelet. The cost of bracelet is 1,80,000 rupees. But Kaushik said, "Sir, because of you only, I finished DT." Okay, he did not, after qualifying, he said, okay, now he is not saying. If he says now means it's like mixing tiger rice. Yeah. So then he said, "Sir, for you I will give it only for 80,000 rupees, sir." 1,80,000 worth of bracelet, he gave it only for 80,000 rupees. All these are dreams. Okay. Even though you do business, he will not give it to me. Correct? Uh, చాలు చాలు అది కూడా ట్యాక్స్ఫుల్ now 1,80,000 worth of bracelet is there. He gave it only for 80,000 rupees. I paid only 80,000 consideration. I did not pay 1 lakh rupees. So how much inadequate consideration is there? 1 lakh rupees. That is greater than 50,000. That is also taxable to me. So gift can be received either at free of cost, that we call as without consideration, or gift can be received for inadequate consideration. Is it clear? Next. In case of immovable property also, gift can be received either for without consideration or gift can be received for inadequate consideration. In total, how many cases are there? 1, 2, 3, 4, 5. So did you understand? I just gave you outline. I did not explain the tax treatment. But like in case of taxability of gifts, in case of valuation of gifts, there are 5 different cases. Case 1, gift that is received in the form of cash. Case 2, gift received in the form of movable property for without consideration. Case 3, gift received in the form of movable property for inadequate consideration. Case 4, gift received in the form of immovable property for without consideration. Case 5, gift received in the form of immovable property for inadequate consideration. Is it clear? Are you able to understand? Now, shall I explain the tax treatment? Is it simple with the example? Okay, I'll go ahead. First, cash gift received. Cash gift received. This is case 1, right? Remember, individual cash gift not. Aggregate of all cash gifts received in a financial year. So here, do you need to check for each individual cash gift or do you need to check for aggregate of all cash gifts? You need to check for aggregate of all cash gifts. Is it clear? So aggregate of all cash gifts in a financial year. Aggregate of all cash gifts in a financial year. If it is less than or equal to 50,000, then it is fully exempt. Aggregate of all cash gifts in a financial year, if it is greater than 50,000, not excess, fully taxable. Okay. If all cash gifts received during the previous year are greater than 50,000, then fully taxable. Okay. Don't tax excess. If you cross the threshold limit, from first onwards he is going to tax. Whole gift is fully taxable. So did you understand case 1? Shall I explain case 2? Everybody, if gift is received in the form of kind gift is classified into two types, right? Kind gift can be received either in the form of movable property or in the form of immovable property, correct? Either in the form of movable property or in the form of immovable property. If gift is received in the form of movable property, such gift can be received either for without consideration or for inadequate consideration, correct? So case 2, case 3. Shall I explain? Movable asset received for without consideration. Here also you should check aggregate. That means aggregation of all movable assets received for without consideration. If that aggregate fair market value, in case of movable asset we will consider fair market value. Aggregate fair market value of all movable assets received for without consideration in a financial year, if it is less than or equal to 50,000, fully exempt. If it is greater than 50,000, not excess, fully taxable. Is it clear? Now, write down. Aggregate fair market value of all movable assets received in a financial year. All movable assets received in a financial year. If it is less than or equal to 50,000, then it is fully exempt. If it is greater than 50,000, then it is fully taxable. So for this also you need to consider aggregate value. You should not consider individual value. Two checkpoints. You should consider aggregate value and you should not consider individual value. Shall I explain further third case? Now, inadequate consideration means what? Inadequate consideration means difference between fair market value and actual consideration. Do you agree with me? The bracelet worth is 1,80,000 rupees. How much I paid? 80,000 rupees I have paid. So difference between 1,80,000 and 80,000 is 1 lakh rupees. That is the benefit received by me. That 1 lakh rupees we call as inadequate consideration. Consideration which was not paid by the individual. Correct? So here also we need to consider aggregate value. Okay, so if aggregation of difference between fair market value and actual consideration for all movable assets received for inadequate consideration, all movable assets received for inadequate consideration, if that is less than or equal to 50,000, then it is fully exempt. If aggregate of fair market value minus actual consideration is greater than 50,000, then total value of the asset is not taxable. Only benefit is taxable. Aggregation of all benefits together will be taxable. Is it clear? Fully taxable. Because think logically, I paid 80,000 rupees. So to the extent of 80,000 it is not taxable. Whatever the 1 lakh rupees that I did not pay, only that benefit, only that inadequate consideration is taxable. So for all movable assets received for inadequate consideration, all inadequate considerations together, if aggregate of inadequate considerations is greater than 50,000, all inadequate considerations are fully taxable. Is it clear? So when you are reading, read like this, fully taxable. The moment you read the word fully means you will forget excess and you will tax it completely. Okay. Next, shall I explain further? Immovable property. Immovable property can be received either for without consideration or for inadequate consideration. Correct? Am I correct? Immovable property received for without consideration. Then, for each immovable property, that means here am I considering aggregate value or individual value? Here I am considering individual value. For each immovable property, if stamp duty value is less than or equal to 50,000, then it is exempt. If stamp duty value is greater than 50,000, then it is fully taxable. Next, shall I explain last case, case 5? In case 5 also, we need to check for each immovable property. For each immovable property. Here it will be a bit different. Listen, you will understand. For each immovable property, if stamp duty value minus actual consideration is greater than 50,000 or 10% of actual consideration, whichever is higher, then taxable value is equal to stamp duty value minus actual consideration. B. If stamp duty value minus actual consideration is less than or equal to 50,000 or 10% of actual consideration, whichever is higher, then taxable value is equal to 0. Taxable value is equal to nil. Do you remember section 50C? In section 50C, for stamp duty value, up to 10% deviation was accepted, right? Stamp duty value is less than or equal to 110% of actual consideration, then actual consideration is to be taken as full value of consideration. Here also, in case of immovable property, what we are taking as base? Stamp duty value we are taking as base. So stamp duty value cannot be exactly equal to value of the property. There will be deviations. That's why up to 10% deviation or general limit of 50,000, whichever is higher. Up to that limit, if there is difference, that is acceptable, not taxable. However, if difference is greater than 10% deviation or generally allowed 50,000, out of these two, whichever is higher. If difference is greater than the higher amount, then in such a case, inadequate consideration is taxable. Are you able to understand the logic? Why 10%? See, here if I have written 5,000 rupees, no doubt to you. Am I correct or not? Here also if I have written 50,000, no doubt is there because gift is exempt up to 50,000 rupees. But 10% deviation is also allowed by department. So 50,000 rupees or 10% deviation, whichever is higher. Okay. If the deviation is till that point, then gift is not taxable. Inadequate consideration is not taxable. If difference is more than that, then inadequate consideration will become taxable. Is it clear? So this is with regard to valuation of gifts. Another point, if gift is received from employer, it is not taxable under other sources, it is taxable under the head income from salaries. Are you able to understand? And if gift is received during the course of business or profession, it amounts to perquisite and it is taxable under the head PGBP. Is it clear, everybody? Now, dividend. Once upon a time, there is a concept of dividend distribution tax (DDT), but nowadays there is no concept of DDT. Whatever the dividend that is received by individual is there, by SSE is there, whether it is from Indian company or foreign company, such dividend is fully taxable in the hands of the recipient. Okay, so whenever you see dividend, tax it under other sources. Okay, next. Not only dividend, even if any deemed dividend is received, such deemed dividend is also income that is taxable under other sources. So, what do you mean by deemed dividend? If accumulated profits of the company are distributed to shareholders, such distribution of accumulated profits to shareholders we call as deemed dividend. First, distribution of accumulated profits, whether capitalized or not, by a company to its shareholders is a dividend if it entails a release of all or any part of its assets. What do you mean by this? For example, if dividend is paid in cash, it is taxable, right? So dividend was not paid in cash. Dividend was paid in the form of assets. Then Act said even if dividend is paid in the form of assets, it is fully taxable in the hands of shareholders only to the extent of accumulated profits. What do you mean by this? For example, company P&L account is looking like this. Assets 80 lakhs, working capital 10 lakhs. Current liabilities, working capital means nothing but current assets, right? Current liabilities 25 lakhs, equity share capital 30 lakhs, reserves and surplus. How much are reserves and surplus? Calculate. Total 90, right? 90 minus 25 minus 30. How much? 30. Reserves and surplus are 35 lakhs. Let's say 40 lakhs worth of assets are given to shareholders. Now 40 lakhs is not considered as deemed dividend. Okay, out of 40 lakhs, how much are accumulated profits? Accumulated profits are only 35 lakhs. So out of 45 lakhs, only 35 lakhs will be considered as deemed dividend under section 2 subsection 2 clause A. Is it clear? So not only dividend given in the form of cash, if any dividend is given in the form of assets, such distribution of dividend to the extent of accumulated profits is considered as deemed dividend. So what is important here to remember is to the extent of accumulated profits. Total 40 lakhs is not taxed under other sources. Out of 40 lakhs, accumulated profits are only 35 lakhs. Now I am changing my example little bit. Listen carefully. Out of 35 lakhs, 10 lakhs bonus shares are issued. How much? 10 lakhs bonus shares are issued. Whenever bonus shares are issued, reserves and surplus will decrease by 10 lakhs and equity share capital will increase by 10 lakhs. Do you agree with me? Double entry system. Reserves and surplus. What is the entry that you will pass for bonus? Reserves and surplus account debit to equity share capital. So equity share capital increases by 10 lakhs. So whatever the amount capitalized to equity share capital is there, this we call as capitalization of profits. Is it clear? Even capitalization of profits is also considered as accumulated profits. To that extent, it is considered as deemed dividend. Is it clear? So, any amount distributed to shareholders in the any assets distributed to shareholders to the extent of accumulated profits, whether those accumulated profits are in reserves and surplus or whether those accumulated profits are capitalized into equity share capital. In this case, even though equity share capital is 40 lakhs and reserves and surplus is 25 lakhs, still 35 lakhs is only considered as deemed dividend, because how much are accumulated profits? Accumulated profits are only 25 lakhs and 10 lakhs. So total accumulated profits are 35 lakhs. To the extent of 35 lakhs only, it is considered as deemed dividend. Is it clear? Simple, right? Shall I explain the next one? Distribution to its shareholders by a company of debenture stock, deposit certificate in any form, whether with or without interest, and any distribution of bonus shares to preference shares to the extent to which company possesses accumulated profits. What do you mean by this? Company gave dividend in cash. It is taxable under other sources. Company gave dividend in the form of assets. It is also taxable under other sources. So company thought, if I give cash and if I give assets, it is getting taxed under other sources. So for existing equity shareholder, one debenture was given. That means what? Dividend is paid in the form of extra security. Dividend is paid in the form of additional asset. So for existing equity shareholders or preference shareholders, if any debentures or debenture stock, if any debenture or debenture stock or deposit certificate are given, to equity shareholders. For preference shareholders, if any debenture stock or deposit certificate or bonus shares. For preference shareholders, even issuance of bonus shares is also considered as deemed dividend. So these transactions are considered as deemed dividend in hands of shareholders to the extent of accumulated profits. Is it clear? Very, very, very important. When you are calculating deemed dividend, you should remember what is important is accumulated profits. Only to the extent of accumulated profits it is considered as deemed dividend. Are you able to understand the logic? Are you able to understand the concept? For equity shareholders, if any bonus shares are issued, that is not considered as deemed dividend. But in case of preference shareholders, if any bonus shares are issued, it is considered as deemed dividend. Is it clear? Next. Section 222C. Distribution made to shareholders of a company on its liquidation to the extent to which distribution is attributable to accumulated profits of company immediately before its liquidation, whether capitalized or not. What do you mean by this? Company got liquidated. On the date of liquidation. Whatever the accumulated profits are there, if those accumulated profits are given to shareholders, that is considered as deemed dividend in the hands of shareholders. Is it clear? Listen carefully. On the date of liquidation, let's say accumulated profits are 47 lakhs. If these 47 lakhs are given to shareholders, that is considered as deemed dividend. What happened after liquidation? Existing assets in the business will be sold, right? Let's say 80 lakhs worth of building was sold for 120 lakhs. 80 lakhs worth of building was sold for 120 lakhs. How much capital gain is received? 40 lakhs capital gain is received. That means what? This 40 lakhs benefit is received after the date of liquidation. So 40 lakhs is not considered as deemed dividend. That means after the date of liquidation, if there is any profit, that profit will not be considered as accumulated profit and it will not be considered as deemed dividend in the hands of shareholders. Up to the date of liquidation, whatever the accumulated profits that are earned are there, if those are distributed to shareholders, it is considered as deemed dividend. Post liquidation, even if any profit is made, that is not considered as accumulated profits and that is not considered as deemed dividend in the hands of shareholders. Is it clear? Are you understanding the concept? then appreciate the beauty of the subject, how well they have written. See, all these are loopholes found by us. For every loophole that was found by us, they started keeping counter, okay, through which we are studying deeper concepts. Next, section 222D, distribution to its shareholders by a company on reduction of its capital. Shareholder, like company thought, if I give cash, dividend. If I give assets, deemed dividend. If I give extra security, that is also deemed dividend. Okay, and if I, like at the time of liquidation, whatever the profit made, like up to the date of liquidation is there, that is also deemed dividend. So he decided equity share capital is there, right? Original equity share capital 30 lakhs. Company decided to give back the share capital. That means shareholders took a decision to reduce their capital because already accumulated profits are there. What income tax act says is, when there are accumulated profits, why are you taking back your own share capital? You can take back in the form of dividend, right? That means the reason for taking back share capital without touching accumulated profits is solely to avoid payment of tax on dividends, correct? So then it said that if you take accumulated profits, dividend. If you do not touch accumulated profits, and if you reduce your share capital when there are enough accumulated profits, even reduction of such share capital is also considered as deemed dividend, and it is taxable under other sources. Is it clear? Shall I explain case 5, section 222E? 222F I will not teach. Don't ask me to teach. It was already discussed in buyback yesterday. At the time of buyback on or after 1st October 24, whatever the amount received by shareholder from company, it is taxable under other sources. भूल गया एक दिन नहीं. Now 222E. Any payment by a company in which public are not substantially interested of any sum by way of advance or loan to the following persons will be deemed to be dividend to the extent of accumulated profits to equity shareholder who is holding greater than or equal to 10% voting power. What do you mean by this? First, if any individual is having beneficial ownership of 20% or more in the company, we call such individual is having substantial interest. So for substantial interest limit is 20%. If any individual is having 10% or more than 10% interest, beneficial interest in any company, we call such individual as beneficial owner. So for beneficial owner criteria is 10%. For substantial interest criteria is 20%. Is it clear? Shall I explain further? Now, there is a private limited company or company in which public are not substantially interested. Company in which public are not substantially interested. If this company gives any loan, to beneficial owner. Beneficial owner means what? Any individual who is having greater than or equal to 10% of equity shareholding in the company, we call them as beneficial owner. So if a private limited company gives any loan to beneficial owner, whatever the loan amount that is given is there, that is considered as deemed dividend in the hands of beneficial owner. Is it clear? Now, beneficial owner thought, if I directly get amount from company, it will be considered as deemed dividend. Even though I get in the form of loan, they are treating it as deemed dividend. So what beneficial owner did? He started a business. In this business, beneficial owner is having 50% stake. His friend is having 50% stake. Now, to this business also, if any loan is given, that loan is considered as deemed dividend. Is it clear? not only to beneficial owner. If any loan is given to any business in which beneficial owner is having substantial interest, here he is having like substantial interest, right, greater than 20% stake. Now even loan given to such business is also considered as deemed dividend, and it is taxable in the hands of beneficial owner. Is it clear? Are you able to understand? Securities premium is not an accumulated profit, and this point I have already explained. Up to the date of liquidation, whatever the accumulated profit is there, only that is considered as deemed dividend. Profit after the date of liquidation will not be treated as deemed dividend. See, if any trade advance is received, that means beneficial owner, if he gets any loan from private limited company, it is deemed dividend. But if loan is in the form of trade advance, that means private limited company is in the business of manufacturing of chairs. Beneficial owner is in the business of selling of wood. Selling of wood. So with regard to purchase of wood, advance is given by company to the beneficial owner. Why loan was taken? Loan was taken in the form of trade advance. Now it is not considered as deemed dividend. Is it clear? Next. Private limited company is engaged in the business of banking. So in the normal course of business, loan is received by beneficial owner. That is also not considered as deemed dividend. Is it clear? Next, shall we discuss casual incomes? Section 115 BB, winning from lottery, betting, gambling, horse races, crossword puzzles, all these incomes are taxable under section 115 BB. Big Boss, Kaun Banega Crorepati, Will Ever Kodishwarudu, all these incomes are taxable under the head income from other sources under section 115 BB. Whatever the income that is earned, on this income, straight away 30% tax is applicable, and along with that applicable surcharge and health and education cess is also there. Okay. 4 benefits are not available against section 115 BB income. First, you cannot claim any expenses. You cannot claim any expenses per section 115 BB income. Like you won a lottery. For earning lottery, let's say you incurred 2000 rupees. You went to that place for playing lottery. That expenditure is not allowed as deduction. Okay, next. Any loss cannot be set off against 115 BB income. That means 115 BB income is fully taxable. Next, chapter 6A deductions cannot be reduced from 115 BB income. Next, basic exemption limit of 2,50,000 or 3 lakhs also you cannot set off against 115 BB income. Is it clear? So he can say directly 115 BB income is fully taxable without any benefit. Okay, but he did not say straight away. He said these benefits are not available. If someone asks where is your nose, you can show like this, or you can also show like this. Correct? He showed in a reverse way. Next, owning and maintaining racehorses is different from winnings. For example, horse race is going on. I did betting on horse races. I said black color horse will win. Through this, if I earn any amount, this we call as winnings. Are you able to understand? Professional horse rider, he won any money. That is his professional income, taxable under the head PGBB. Professional horse rider, his horse is sick. So he wanted a new horse to participate in the race. Okay, there is a guy who owns a horse, who owns horse races. He is maintaining those horses. Okay, like he is keeping food, fodder, everything and all. Now horse racer went to the person who is owning and maintaining race horses and took horse on rent only for the purpose of horse race, and he paid 50,000 rupees amount for taking rent. This 50,000 rupees income we call as income from owning and maintaining race horses. Are you able to clearly understand the difference? Winning from horse races is different, income from owning and maintaining race horses is different. Winning from horse races is purely contingent. We do not know which horse wins. Okay, so that income is taxable under section 115BB, casual income. Owning and maintaining race horses, there is effort. Okay, like he started purchasing the horses, he started breeding the horses, he kept food for it, so there is some maintenance and all. So by way of giving horse on rent, or like by making horse participate in a horse race, if he gets any stake, that stake we call as income from owning and maintaining race horses. Many people will get confused if they do not have idea. Okay, they will just think winning from horse races everything is same, but it is not same. Both are different. Income from owning and maintaining race horses is taxable separately under the head other sources. For that 30% tax rate is applicable. Not applicable, normal tax rates are only applicable. Another important point, if you are owning and maintaining race horses, you can claim respective expenses, but when you are having income from 115BB winnings, you cannot claim any expenses. I already told you it is taxable on gross basis. Are you able to understand? You should be clear conceptually. Okay, otherwise IC will play with you. Next, where certain percentage has to be foregone by the winner to government. ఏంటి అరుస్తారు అక్కడ క్లాస్ చెప్పాలి వద్దా? Now I won 80,000 rupees in betting. Out of 80,000 rupees won by me, voluntarily I gave 20,000 rupees to central government. If any amount is voluntarily surrendered to central government, that amount is not taxable. Okay, in this case only 60,000 is taxable under the head other sources. Is it clear? Next, interest. Actually there is some editing mistake. This is not casual incomes, this is interest tax treatment. Please change it here also. Listen quickly. See, I deposited 10 lakh rupees in fixed deposit. From date of deposit up to date of withdrawal, he will pay me interest. That means other than on securities, interest is paid based on period of holding. Do you agree with me? Fixed deposit is not a security. Other than on securities, interest is paid based on period of holding. If SSE is following accrual basis of accounting, on accrual basis he will calculate interest for number of days and it is taxable to the SSE. If SSE is following cash basis, the date on which he got the interest amount credited to his bank account, on the date that income is taxable. In case of securities, interest is paid not based on period of holding, but interest is paid based on due date. So on due date, for example, due date for payment of interest is 16th March. Today I purchased the debenture. Even though I held the debenture for only one day, still I am entitled to receive 365 days interest. Are you able to understand? So in case of securities, interest is paid not based on period of holding, but interest is paid based on due date. Is it clear? So interest is calculated, interest is payable on due date irrespective of period of holding. Even though I held it for only one day, still total 365 days interest is taxable to me. Are you able to understand? Next, year of taxability. Accrual basis, taxable in the year in which such interest falls due. If a SSE is following accrual basis of accounting, on the due date, whether he gets interest or not, that interest is taxable to him. If he is following cash basis, irrespective of due date, when he got interest, then only it is taxable. Is it clear? Next, I told this point, in case of post office savings account, interest exemption is available up to 3,500 in case of individual account. If it is joint account, 7,000 rupees exemption is available. Next, Write down here allowable expenses or deductions. Shall I explain? Family pension received is taxable under other sources. Why? There is no relationship of employer and employee in between employer and family members of the employee. That's why whatever the family pension received, it is taxable under other sources. But total family pension is not taxable. You can claim exemption. How much is exemption? Exemption is equal to 1/3 of pension or 25,000. Very important amendment as per Finance Act number 2 of 2024. 1/3 of pension or 25,000, whichever is lower, under default tax rates. Under optional tax rates, old provision will remain. Under optional tax rates, amount of exemption is equal to 1/3 of pension or 15,000, whichever is lower. Is it clear? 1/3 of pension or 15,000, whichever is lower. This benefit is available under optional tax rates. Major amendment Finance Act number 2 of 2024. So the family person who is receiving the pension, if they are paying taxes under default tax rates, they can claim exemption up to 25,000 under other sources. If they are paying taxes under optional tax rates, they can claim exemption only up to 15,000 rupees. For example, like family member is receiving pension of 20,000 per month. Okay. Let's suppose they are paying taxes under default tax rates. How much is family pension? 20,000 into 12, it will be 2,40,000, correct? From 2,40,000, exemption is allowed. How much exemption is allowed? 1/3 of pension or 25,000, whichever is lower, correct? 1/3 of pension means 80,000, right? Or 25,000, whichever is lower means 25,000 is allowed as, actually this is not exemption, this is deduction. Okay. How much will be taxable? 2,15,000 is taxable under other sources. Is it clear? Did you understand? If any dividend income is received, for example, I took loan of 1 lakh rupees from Kaushik to invest in Reliance Limited shares. Kaushik said, "Sir, even though you are faculty to me, I am a businessman. I will not give loan to you at free of cost. Rate of interest is 9%. He said, "Idi yaparam." Okay. So he gave loan of 1 lakh rupees and rate of interest is 8%. I said, okay. I invested this 1 lakh amount in Reliance Limited shares. From Reliance Limited shares, I got a dividend of 25,000. If yours is business, mine is also business, and I earned a dividend of 25,000 rupees. From this dividend, like to earn 25,000 rupees, I paid interest of 8,000 rupees, right? Do you agree with me? So if any dividend income is earned, for that, if you pay any interest expenditure, such interest expenditure is allowed as deduction. Other expenses are not allowed as deduction, but total interest expenditure is also not allowed as deduction, subject to limit. Deduction is equal to 20% of dividend income or actual interest, whichever is lower. 20% of dividend income, 5,000, right? 25,000 into 20%. అరే నాకు వచ్చింది కొంచెం మ్యాథ్స్. 25,000 into 20%, 5,000 or actual interest 8,000. Whichever is lower means 5,000 is allowed as deduction and balance 20,000 is taxable. Is it clear? Next, interest on compensation or enhanced compensation. We have seen if any enhanced compensation is received, on that if any interest is paid, interest on compensation or enhanced compensation is taxable under other sources, but totally is not taxable. 50% deduction is allowed, balance 50% is only taxable. Against winnings, no expenses. I told you, right? Against winning from lottery, betting, gambling, you cannot claim any expenses. Against other income, let's say you are earning royalty income. For earning royalty income, if you pay any expenses, those expenses are allowed as deduction. You are earning income from subletting. Okay, for subletting, if you earn any, like for earning that subletting income, if you pay any expenditure, that expenditure is also allowed as deduction. Do you remember section 37? Section 37 under PGBP, general deduction. There are certain conditions. If all those conditions are satisfied, then all residuary expenses will be allowed as deduction. Expenditure should be revenue in nature. It should be for the purpose of business. It should not be covered under 30 to 37. It should not be a preliminary expenditure. It should not be a penalty. If all these conditions are satisfied, expenditure is allowed as deduction. Same section 37 provision is given here also. That means under the head other sources, to earn any income, if any expenditure is incurred, that expenditure should satisfy these conditions. That expenditure should be revenue in nature. Okay, that expenditure should not be capital in nature. That expenditure should be purpose of earning income under other sources. If all these conditions are satisfied, then only expenditure is allowed as deduction. I am earning royalty income. To type the book, I recruited one assistant. For that assistant, I am paying amount. So this expenditure is paid with regard to earning royalty. Now this expenditure is revenue expenditure. It is not capital expenditure. Okay, and it is solely incurred for earning royalty income. If all these conditions are satisfied, 10,000 rupees salary paid to assistant is allowed as deduction. Is it clear? Next, you know, right, personal expenditure is not allowed as deduction. So whatever, this is 40A1 provision. I think I have discussed very clearly 40A1. 40A1A also I have discussed. Okay, next I have discussed 40A3. 40A3. Next I have discussed 40A2. So whatever 40A2, 40A3, 40A1, 40A1A, these provisions under PGBP are there, same provisions will also apply under other sources. Is it clear? So it's all about income from other sources.